SLV is undergoing an extreme multi-day sell-off that has violently erased a large portion of its recent gains, marking one of the sharpest drawdowns in years. The speed and magnitude of the decline have reignited intense debate across the trading community, with many participants alleging coordinated market manipulation as leveraged paper positions unwind en masse. Bulls argue the sell off highlights a growing disconnect between futures driven price action and conditions in the physical market, where silver remains scarce, premiums remain elevated, and overseas demand, particularly in Asia, shows little sign of slowing. From this perspective, the collapse in paper prices is viewed less as a reflection of weakening fundamentals and more as a forced deleveraging event driven by margin calls, options expirations, and algorithmic selling cascades. At the same time, bears contend that silver had become excessively stretched after its parabolic run, leaving it vulnerable to a brutal reset once momentum cracked. They point to crowded speculative positioning, elevated volatility, and the sensitivity of silver to macro shifts as reasons the metal could remain under pressure in the near term, even if the long term supply narrative remains intact. The result has been a highly emotional market, with sharp intraday reversals, rising volume, and a growing split between short term traders and long term holders. GLD is also trending sharply lower after a significant price drop that has shaken confidence in gold's previously relentless advance. Much of the weakness is being attributed to expectations of a stronger US dollar following Kevin Warsh's nomination as the new Federal Reserve Chair, a development that markets interpret as a more hawkish shift in monetary leadership. This narrative has been amplified by widespread margin calls across commodities and macro trades, forcing liquidations even among traditionally defensive assets like gold. As prices fell, volatility spiked, reinforcing the perception that gold's move had become increasingly crowded and vulnerable to sudden air pockets. Despite the drawdown, the gold community remains deeply divided. Some fear the move marks the bursting of a speculative bubble after a historic run, arguing that tighter policy expectations and a resurgent dollar could cap upside for an extended period. Others, however, view the sell off as a rare and potentially engineered shakeout, emphasizing that central banks continue to accumulate gold at a rapid pace. Geopolitical risks remain unresolved, and long term concerns around fiscal deficits and dollar debasement have not disappeared. From this camp's perspective, the current weakness represents not a structural breakdown, but a violent reset that may ultimately reinforce gold and silver's role as long term monetary hedges once forced selling subsides.
Okay, silver is down 12.08%. This is the pre-market session of Monday, the 2nd of February. So SLV and GLD, they are not trading yet. Okay, so but we have been able to break down what's going on with silver. Let's see what we have, if this is going to come up. Yeah. Okay, so we have devastating technical damage. Trading this silver's trading below all of its simple moving averages. Okay, 10, 21, 40, and 200. Critical observations: severe mean reversion setup, price compressed 25% below 10-day moving average, extreme dislocation, simple moving average cascade failure, all short-term moving averages in steep decline. The 10-day moving average is dropping, losing $1.62 every day in severe trend mode. Yeah, severe negative trend mode, severe bearish trend mode. And then building reversal potential. Okay, all the price pressure momentum indicators, derivatives show deceleration, second derivative positive across all time frames. Okay, and then this is the market grid. These are the potential prices that gold has, silver has. Let's see now. 63.39 will be capitulation extreme, 68.57 high panic zone, and much more. 80.14, just slightly above where it is right now, will be primary targets, and this is current level, current proximity likely test. Yeah, okay. 90.49, convergence of the that will be convergence with its 21-day moving average. 96.27 extreme resistance, 102.06 extreme extended rally, 107.23 unlikely without catalyst. Okay, trade setup. No guarantee that if you try this that you will succeed. Okay, short term setup 5 to 15 days. Entry zone will be current levels 7.2 72.5 to 75.50, just slightly above the current level, so this is below. It's still below. And well, it's still within it. 72.5 to 75.50 current area, yes. And then your probability of success is 65%. Rationale, extreme deviation from all moving averages creates a rubber band effect. And the 21-day moving average, which is dropping, which is still gaining 11 cents every day, entering maintenance mode, signals deceleration. All the price pressure momentum indicator derivatives are all positive. Momentum is bleeding out. Um, Physical demand divergence suggests institutional accumulation. So your target will be 80.14, 45% probability. Okay, so $85 will be your second target, 90.49 your third target. These are the probabilities. Okay, okay. So these are what you take off if you achieve if you achieve that 80.14. Yeah, you take off 50%, and then and much more. Your stop loss will be $68. Invalidation break below 68.5 will increase with increase in volume is equal to structural failure. Long-term setup, accumulation setup, manufacturer dislocation. Thesis, paper price manipulation creating a generational physical buying opportunity. The 200-day moving average, which is rising, which is gaining 43 cents every day in healthy trend mode, long-term uptrend intact. Okay, the 200-day moving average, okay, yeah, and yeah, at 48.54 to $65 within 12 months structural supports. Current price 54% above that 200-day moving average, historical bullish. Yeah, phase strategy. Okay, you can always pause and read. Okay, so scaling into longs within 2 to 1 position with bias favoring a short-term tactical bounce over long-term accumulation, giving elevated volatility and much more. So yeah, you can always pause and read all through and see what you make of what's going on with silver. We could just quickly have a look here. It's saying here that yeah, it's we should expect a consolidation to play out from tomorrow, the 3rd of February. Yeah. Okay, let's just see what we have for gold. Good. It's indicating here that from Thursday the 5th, it might resume the uptrend, but is expected to continue to weaken up till Wednesday the 4th. Yeah. Momentum is also expected to continue to weaken and maybe begin to pick up from Thursday the 12th of February. Okay. Yeah. So just see what you make of all of these stocks, all of some of these two metals. But before we go, let's see what we have For gold, in terms of projections, we have current upper projection 5348, regardless, 5348, still being reiterated today, even with this weakness, this 6.92% still indicating that 5,348 is possible. It's printed an intraday high of all-time high of 5413 on Wednesday 28th. And I had a few previous upper projection of 5365, 5617, still retracing those sort of levels. 4956 as well. Yeah. And it did also lower prices. Yeah. Okay. So thank you very much for watching this video.